Hey everyone. In this class, we are going to cover chapter 1 of your textbook, Accounting in Action. And this chapter is basically an introduction to financial accounting. It is also an introduction to this course. So specifically in today's class, we're going to talk about 3 topics. First, we are going to talk about what is accounting. We already talked about it in last class, and in this class, we're just going to talk about it more. And then we're going to talk about the basic accounting principles and the basic accounting assumptions. And lastly, we're going to talk about the basics of accounting. So the basic accounting equation, some of you may have already heard about it before, which is asset equals to liability plus stockholders' equity. And then we're also going to talk about the 9-step accounting cycle. So when accountants, they do accounting, they need to follow 9 steps accounting cycle. So this is the plan for today's class. First of all, this is an accounting course. And I guess that a lot of you may take this course just because you have to take it. So it is one of the core courses for all of the business majors. And some of you may be interested in other areas in business, for example, marketing, finance, management. I want to start off here by explaining to you why this course is one of the core courses that is required for all of the business majors. Why is it important to know accounting, even as someone who may be interested in other areas in business? So let's watch this video clip by Warren Buffett. Warren Buffett is one of the most successful investors of all times. And let's look at what he says about accounting.
I learned here, but I learned a lot. But the most valuable was accounting, and we had a wonderful professor named Ray Dean. There may even be something named for him down here, isn't there? Yeah, he was. I'd been to the Wharton School. I went to Columbia Graduate School subsequently, and I took a lot of accounting courses. But by far the best instruction I received in accounting came from Ray Dean, and there's nothing more important. People ask me what they should take in business school, or even if they don't go to business school, what they need to know before getting in business. And I tell them, you have to understand accounting. It's the language. I mean, it's like being in a foreign country without knowing the language. If you're in business and you don't understand accounting, so you want to get as comfortable with that as you are with the English language. It's made me a lot of money because I listened to what Ray Dean had to say 53 or 4 years ago, and have been able to understand what I was seeing on pieces of paper, what that told me about businesses, and the limitations of what it told me about businesses. But that's the way we invest. Yesterday, I was in Knoxville, Tennessee, and we bought a company. We agreed to buy a company called Clayton Homes about a week ago. It's a big company in the manufactured home business. We agreed to pay $1.7 billion for it. I made that deal over the phone without ever meeting the people there, but I had seen enough through reading 10Ks, 10Qs, annual reports, but looking at figures, what they tell me in terms of the kind of people even running the place, the kind of accounting decisions they make, and so on. I was able to make that $1.7 billion transactions over the phone. Yesterday was the first time I met the people, and their board of directors had actually approved the deal a week earlier. So it's, I couldn't have done that if I hadn't have, I had a great time at Ray Dean's class. 53 years ago. So if I'm going to tout one thing, aside from this particular leadership class, of course, if I'm going to tout one thing, I would tell you that get comfortable with it. You know, it may not happen the first week or the first month in the class, but get very comfortable with accounting. So that I run into CEOs periodically who really don't understand it. You know, they try to bluff their way through, and you can see in their faces, they're frightened almost when somebody hands them a balance sheet or an income statement. They really don't know what it means, and they have to count on somebody else. And that's something you shouldn't count on. We make all our acquisition decisions ourselves. I mean, we don't call in consultants or anybody. We don't call in investment bankers, much to their disgust. No investment banking fees in the Clayton Holmes deal, because you know it's my responsibility running Berkshire to understand enough about our acquisition decisions to make them based on the numbers that I see and what I see there.
This question is from Max Taylor of Chicago.
Okay, so that's the advice from Warren Buffett. You just have to know accounting. So and also Warren Buffett mentioned in his talk that accounting is the language of business, and that is very true. So it's just like if you go to a foreign country, for example, if you go to China, you want to talk with the people there, you want to know the culture. You have to know Chinese. And then if you come to the US from another country, you want to talk with the people here, you want to know the culture here, you want to know what's going on here, you have to know how to speak English. So knowing accounting basically increase your business literacy so that you can speak better in the business field. And now let's give accounting a more formal definition. So it's very similar as what we said, that accounting is the language of business. So what does language do? Language basically communicate information. The purpose of language is it enables us to communicate information. So similarly as accounting, what is accounting? Accounting is, first of all, it is an information system, and it enables the firm to communicate information about its business. So it is an information system that identifies and records the economic event of our organization and communicate them to interested users. And so as we mentioned in last class, depending on who those interested users be, so those users can either be external users. And examples of external users, they can be the firm's creditors or investors. And those users can also be internal users, for example, firm's management. And then there's another kind of external users, but we tend to separate them out. Those are tax authorities. So depending on who those interested users be, the kind of information system, they can be different because they need to provide, different users have different needs. And the information system needs to be different in order to tailor to the needs of different information users. And specifically, the kind of information system that provides information to the firm's external users, that is called financial accounting. So now let's give financial accounting a more formal definition. What is financial accounting? Financial accounting, it is an information system that identifies and records the economic events of an organization and communicate them to the firm's external users. So that is the definition of financial accounting. And this course is an introduction to financial accounting course. Or in other words, that the purpose of the information system we are going to learn in this course, the purpose is to provide information to the firm's external users, most importantly, the firm's investors. So one thing we need to know is all of the publicly listed firms, they need to comply with the same financial accounting rules. So the financial accounting rules that from all of the publicly listed firms use, those are the same financial accounting rules. Probably you can imagine that what is going to happen if different firms use different financial accounting rules. For example, Google is using one set of financial accounting rules versus Apple is using another set of financial accounting rules. You as the information user, as an investor, you look at two firms' financial reports, and if two firms use different rules to generate those financial reports, it will be very hard for investors to compare those firms. So that's why that for all of the publicly listed firms, they need to comply with the same financial accounting rules. And it is different for managerial accounting. Google can have its own set of managerial accounting system versus Apple has its own set of managerial accounting system. That doesn't matter because the purpose for managerial accounting is to provide information to the firm's managers, and they don't need to, they have no idea of what, for example, as Google's managers, they don't even have the information what the managerial accounting system is providing, what kind of information is provided by that system to Apple's managers. They don't even have that information. So it is not, different firms can have different managerial accounting system, but for financial accounting, different firms need to have the same set of, need to comply with the same set of financial accounting rules. We talked about that all of the firms need to comply with the same set of financial accounting rules. And in the United States, that set of financial accounting rules, that is called US Generally Accepted Accounting Principles. And in short, it is called US GAAP. So who set US GAAP? The government body that set US GAAP, it is called Financial Accounting Standard Board, FASB. And FASB, it is overseen by SEC, Security and Exchange Commission. This is within the US because we're talking about the US GAAP. And how about outside of the US? Outside of the US, the other countries, a lot of them do not use US GAAP. They use another set of accounting principle called International Financial Reporting Standards, IFRS. And who set International Financial Reporting Standard? Those are issued by another government body. It is called International Accounting Standard Board, RASB. So this is a map of which countries adopt which standard. And as you can see here that the only countries that adopt US GAAP are those countries, the countries in yellow. And outside of the US, almost everyone else, they adopt IFRS. So this is something that you need to keep in mind. In this course, the financial accounting standard we're learning in this course, it is the US GAAP. However, you should keep in mind that a lot of the other countries outside of the US, they actually needs to, the companies in those countries, they need to follow a different set of accounting standards, which is different from US GAAP. So although those two set of accounting standards have a lot in common, but they're not exactly the same. So we have talked about the US GAAP, which is basically the set of accounting standards that all of the US publicly listed firms need to follow. And US GAAP is basically, it is based on some basic principles and assumptions. For example, we have talked about how to measure different items. It is a very important topic in accounting. And there's more than one way to measure the same item. So for example, I may bought a desk at $200, and the price I bought the desk was $200. However, at the end of the year, the fair value of the desk may be $150. So at which price should I measure the desk? So that is a question. I can either measure it at $200 or I can measure it at $150. And this is a question for accountant, how to measure it. And if I decide to measure it as $200, I basically I'm following the historic cost principle because $200 was the historic cost. It was the cost that I bought the desk at. And if I decide to measure this desk at $150, I'm following the fair value principle because $150 was the fair value of the desk at the time of measurement. So I basically have two ways that I can use to measure those. And then how do I decide which principle to use? How do I decide whether to measure it at $200 or $150? That's another question for accountant. And basically the principle here is how to measure it. It depends on which principle enable us to provide the most useful information to information users. So for example, land that companies own, they are usually measured at historic cost, and investment is usually measured at fair value. Because investment, for example, a firm may own some stocks. They may bought the stock at $50, and at the end of the year, the fair value of the stock may be 100. So 100 here, if the firm decide to sell because the firm can sell the stock at any time. So 100 measuring stocks at its fair value, which is $100. That is more relevant information and more useful information for investors, because that $100 is closer to the real value of the investment versus $50, which the investors bought the investment at. And we have talked about those two measurement principles. GAAP is also based on some assumptions, and two of the most important assumptions, one is called monetary unit assumption, the other is called economic entity assumption. And what is monetary unit assumption? The monetary unit assumption basically says that companies record only events that can be measured in money. So what does this mean? It just means that whatever cannot be measured in money, companies do not record those events. Not all events can be measured in money. For example, the health of a company's owner, how can you measure it in money? It's very difficult to measure it in terms of money. So companies do not need to record those. The quality of service, it is also very difficult to measure those in money. So those are not recorded by companies either. This is monetary unit assumption. The other important assumption is economic entity assumption. Basically, the assumption is basically the activities of the entity is kept separate and distinct from activity of owners. Yeah, this is economic entity assumption. So we have talked about some fundamental concepts in accounting, including what is accounting, what is financial accounting, what are the basic principles and assumptions in accounting. And now let's look at the basics of accounting and how accounting is done. The basic accounting equation is basically asset equals to liabilities plus stockholders' equity. And this is a very important equation If there's never one thing I want you to take away from this course, it is this equation. Asset equals to liabilities plus stockholders' equity. So what is asset? Asset basically represents the resources a business owns. It can be cash, it can be supplies, it can be equipment. It's just everything the company owns. And what are liabilities and stockholders' equities? Liabilities and stockholders' equities, those represent the rights and claims against those resources. Specifically, liabilities represent claims of those to whom the company owned the money, the claims from the company's creditors. And examples can be account payable. So account payable represent claims from the firm's suppliers. When the firm buys goods from its suppliers, sometimes the firm buys it on credit, meaning that the firm is not paying cash right away. The suppliers allow the firm some time until the firm has to pay the money back. So, and this is recorded as account payable. It's a liability to the firm's suppliers. Notes payable. So sometimes when the firm lend money and the firm write a note to those creditors, that becomes the firm's notes payable. Salary and wage payable. So the firm may own some salary to its employees. Sales and real estate tax payable. So that's the money the firm owns to the government. And then stockholders' equity. What is stockholders' equity? Stockholders' equity, basically, it represents claims from the firm's owners. Two of the major items in stockholders' equity, those are common stock and retained earning. And common stock basically represents the total amount paid in by the stockholder for the shares they purchase. Retained earning represents the amount earned by the corporation. So at the time a firm was established, the firm's stockholders investing in the firm, and the common stock account represents the amount paid by stockholder. And then after the firm is able to purchase some basic ingredient, the raw material, machines, equipment, and then it begin to operate, it will be able to generate some earnings by itself, and the amount earned by corporation, that is recorded in retained earning. So specifically, retained earning is determined by three components. First of all, revenue. So the revenue the firm earns, it is going to increase a firm's retained earning. And then expense. In order to earn those revenue, the firm needs to occur some expense, and the expense basically decrease retained earning. And after the firm has earned enough money, the firm may decide to distribute some of its earnings. So the distribution of cash and other assets to stockholders, that is called dividend. Dividend is not expense. It is separate from expense. It is after the firm has calculated what is net income. So what's the difference between revenue and the difference between revenue and the expense? That is net income. So after the firm has calculated its net income, the firm may decide to take some money out of its net income and distribute it to the firm's stockholders. And that is called dividend. And dividend is going to decrease a firm's retained earning as well. So if you are a little bit overwhelmed by all of those new terms, that's okay. We're going to come back to talk about those terms repeatedly in the rest of the semester. And here I just want to give you an overview of so what is the basic accounting equation, and what is asset, liability, stockholders' equity, and what are some of the accounts. And here, this graph just summarized what we just said. So this is the basic accounting equation. And within assets, we have a lot of different accounts. We have cash, we have, for example, account receivable, inventory. We're going to talk about all of those accounts in the rest of the semester. And within liability, we may have account payable, note payable, salary payable, and etc. Some other liability accounts. Stockholders' equity. So two of the major stockholders' equity accounts. One is common stock, the other is retained earning. And retained earning is increased by revenue, decreased by expense, and decreased by dividend. So this summarizes the accounting equation. And we just talked about the accounting equation. Another basics of accounting is how accounting is done. So accounting equation doesn't tell us anything about how accounting is done within the firm. In order to do when accountants do accounting in the firm, they need to follow a procedure, and that procedure has 9 steps. So we first begin from analyzing the business transactions occur continuously in the firm. And after those business transactions occur, the first job for accountant is to analyze those business transactions. And then we do journal entry. It is called journalize, which is basically make journal entry. And what is a journal entry? It's basically debit something and credit something else. We're going to talk more about it. And then the third step is to posting. So once we have a journal entry, we debit some account, for example, account A, and credit some other account called account B. And those amounts are posted to account A and posted to account B. So that is called posting. So here I just want to give you an overview, and we are going to talk more about it in the rest of the course. And step 4 is a trial balance. So what is a trial balance? Here, this journal entry just touch upon 2 accounts, account A and account B. And we may have some other business, we may have a lot of other business transactions occur during the year. And then those business transactions, we touch upon some different accounts. Yeah, and all account A and account B repeatedly. So at the end of the financial reporting period, we look at all of our accounts, and then we do a summarize of what is the ending balance for different accounts. So, and then we take the ending balance for each account. We make a list of all of the account, for example, account A, account B, account C, and all of its ending balance. We put those into a list, and that is called a trial balance. And then step 5 is to make adjusting entries. So some of the events that happen during the year, we do not have a outside document, and then which do not initiate, which do not trigger a step 1, the step 1 for us, analyze business transaction. So for those events, we need to make some adjusting entries at the end of the financial reporting period. And then after we have made the adjusting entry, those adjusting entries are posted to different accounts. And then we need to adjust our trial balance, which is step 6. So we're going to have a new trial balance called adjusted trial balance with the new balances for account A, B, C, and etc. And then step 7 is the financial statement. So based on the adjusted trial balance, we can make, so we take, for example, A is cash, and cash is an asset account, and the place we should put cash is on the balance sheet. So we just put those accounts into different financial statements, and that is step 7. And financial statement is usually included in forms like 10K report or 10Q report of firms. And those reports are disclosed to the firm's investors. And after we have made the financial statement, that is not the end. We have 2 more steps. Step 8 is to make the closing entry. The purpose of the closing entry is to close out some of the permanent account of some of the temporary accounts of the firm. And then so that in the next period, we can, for those temporary account, we can start from 0 again. And then steps 9 is the post-closing trial balance, which is basically after we have made those closing entries, we do the posting and we adjusted the ending balance for each account. And then we compile those accounts into a list, and that is called post-closing trial balance, which basically tell us what is balance for account ABC, different accounts at the end of the financial reporting period. So, and after we have done the closing entries. So that is the overview of the 9-step accounting cycle. And in today's class, we're going to talk more about step 1, analyze business transaction. We're also going to talk more about step 7. So the step 7 generates the product of this accounting cycle, generates the most important product of this accounting cycle, which is the financial statement. If you are investors for a firm, you do not get to see any of the 9 steps, except the output of step 7, which are the financial statement. So you don't, as investors for the firm, you cannot see the firm's journal entries. You cannot see its account. You cannot see the trial balance. The only thing you can see is the financial statement and some other information that is disclosed in the firm's 10K or 10Q report. So let's start from talking about step 1, analyze the business transaction. And so what are transactions? Step 1 is to analyze the business transaction. So what are transactions? Transactions are basically business economic events recorded by accountant. So those are basically economic events which happens. They can be, for example, Starbucks sold a cup of coffee, that is one transaction. Starbucks purchased coffee beans, that is another transaction. And Starbucks pay its workers, that's another transaction. So all of those are called the business transactions. And what do we mean by analyze business transaction? By analyzing business transaction, we basically mean that we need to analyze the effect of the transaction on the components of the accounting equation. So if you still remember what we talked about 5 minutes ago, the accounting equation is assets equals to liability plus stockholders' equity. And analyzing the business transaction basically means that we analyze the effect of the transaction on asset, on liability, and on stockholders' equity. And if there is an effect, or in other words, if the business transaction affects a firm's asset or liability or stockholders' equity, we need to record the transaction. If there's not an effect, if there's no effect, we do not need to record the transaction. And here are some examples. For example, if the firm purchased computers, the purchase of computer, the firm may spend cash. So cash is an asset is affected. And the purchase of computer, now the firm has computer is an asset is affected as well. So this business event actually has a dual effect on asset. It increases a firm's fixed asset, which is computer, and it decreases the firm's cash. But all in all, it does affect the accounting equation, and which means that we do need to record it. And then discuss product design with potential customer. Does this event affect asset or liability or stockholders' equity of the firm? The answer is no, it doesn't. And so for this event, we don't need to record it. Pay rent. So if the firm pay rent, the firm's liability may decrease, and the firm is paying out by cash, for example, and cash decrease as well. So it decreased the firm's asset. At the same time, it decreased the firm's liability as well. So it does affect the firm's accounting equation, which means that we do need to record it. So in other words, that so each transaction actually it must have a dual effect on the accounting equation. And let's look at some examples of transactions. So investment, the first transaction is investment by stockholders. A and B decide to start a smartphone app development company, and they incorporate AB Inc. On December 1st, they invested 15,000 cash in the business in exchange for 15,000 of common stock. How does this transaction affect the firm's, so this AB Inc.'s accounting equation? Please take 1 minute, think about it, and you can pause your video for now. So how does this event affect the AB Inc.'s accounting equation? First of all, they invested 15,000 in cash. So if you stand from AB Inc.'s perspective, AB Inc. has 15,000 more cash. Cash increased by 15,000, and because cash is an asset, so asset increase. At the same time, the firm has investors. So those represent, this $15,000 represent ownership by A and B. So common stock increase. And because common stock is part of stockholders' equity, so stockholders' equity increase. So this is the first transaction. And then AB Inc. decide to purchase computer. So now AB Inc. has some money, has 15,000. It decided to purchase computer equipment for 7,000 in cash. How does this transaction affect the firm's accounting equation? In order to purchase this computer equipment, AB Inc. is spending 7,000 in cash. So cash decreased by 7,000. And because cash is an asset, so asset decreased by 7,000. And using the 7,000, AB Inc. purchased the computer equipment. So now the firm has an equipment which was 7,000. So equipment increased by 7,000, and because equipment is an asset, so asset increased by 7,000. So this dual effect is a decrease in asset at the same time an increase in asset. So this is the second event. And now let's look at the third one. AB Inc. may decide to purchase 1,600 headsets and other accessories expected to last several months. The supplier announced AB Inc. to pay this bill in October. So how does this event affect the firm's accounting equation? You can pause your video for now. Please think about it for a minute. The effect of this event on the firm's business equation. The firm purchased those headsets and other accessories. So supplies increased by 1,600. And because supplies is a kind of asset, so asset increase. And the supplier allowed AB to pay this bill in October. So AB Inc. didn't pay this bill directly in cash. Instead, it is accruing a liability. So because now it owns its suppliers 1,600, and this is called accounts payable. So accounts payable increased by 1,600, and because accounts payable is a liability, so liability increased by 1,600. AB Inc. may also receive 1,200 cash from customer for app development service it has performed. So how would this affect the firm's accounting equation? So AB received 1,200 in cash. Cash increased by 1,200. And because cash is an asset, so asset increased by 1,200. And for app development service it has performed. So this is a revenue for the firm. Revenue increased by 1,200. And because revenue is increased the firm's retained earning. So retained earning increased by 1,200. And because retained earning is part of stockholders' equity, so stockholders' equity increased by 1,200. The next one, purchase of advertising on credit. AB receives a bill for 250 from Daily News for advertising on its online website, but postpone payment until a later date. How would this affect the firm's accounting equation? So the firm advertised on AB News website, and it received a 250 bill for that, but the firm hasn't paid for it yet. So now the firm owns some money to the Daily News, and this is 250. It's account payable. It is payable. It is a liability to AB News. So liability increased by 250. And also, it is an advertising expense for the firm. So advertising expense increased by 250. And because expense decreased retained earning, so retained earning, so this increase in expense decreased the firm's retained earning. And because retained earning is part of stockholders' equity, so stockholders' equity decreased by 250. So this event has a dual effect on the firm's liability and stockholders' equity. The next one, service provided for cash and credit. AB provides 3,500 of service. The company received cash of 1,500, and it bills the balance 2,000 on account. How does this event affect the firm's accounting equation? So the firm provides 3,500 of service, and this generates revenue for the firm. So revenue increased by 3,500. And then the firm received cash 1,500. So cash increased by 1,500. And they bill the balance 2,000 on account. So this is called account receivable. The firm has the right to receive this 2,000 from its customers. So, and cash is an asset. Account receivable is an asset. So asset increased by 3,500. And retained earning is a stockholders' equity account. So stockholders' equity increased by 35,100 as well. Next one, payment of expense. AB paid the following expense in cash. And how does this event affect the firm's accounting equation? So the firm has office rent 600, salary and wages 900, utilities 200. All of those are expense for the firm. So expense increased by a total of 1,700. And because expense decreased the firm's retained earning, so retained earning decreased by 1,700. And because retained earnings are stockholders' equity account, so stockholders' equity decreased by 1,700. And because all of those expenses, the firm paid out by cash, so cash decreased by 1,700. And cash is an asset, so asset decreased by 1,700. Next one, payment of accounts payable. AB pays its 250 daily news bill in cash. And if you still remember that in transaction 5, the firm incurred those expense. So now the firm, at that time, the firm put it on account. And now the firm pay out those account payable that it owns. So how does this affect the firm's accounting equation? The firm pay out those account payable. So after paid out those bills, the firm no longer own any money to daily news. So account payable decreased by 250. And because account payable is a liability, so liability decreased by 250. And because the firm pays it out in cash, so cash account decreased by 250, which means that asset decreased by 250 as well. Next one, receipt of cash on account. AB Inc. receives 600 in cash from customers. So this is coming from transaction 6. If you still remember that in transaction 6, the firm provided some service and some of it put it on account. And now the firm collected some of those account receivable back. So how does this affect the firm's accounting equation? So first of all, the firm received 600 in cash. Cash increased by 600, and cash is an asset, so asset increase. And now because the firm has already received those outstanding bill, so the firm no longer has the right to collect it in the future because the firm already received it. So account receivable decreased by 600. And account receivable is an asset. So asset decreased by 600. So this has a dual effect on the asset account. The assets account. The next one, dividend. The company pay out dividend of 1,300 in cash. How does this affect the accounting equation? So the payoff out of dividend, the firm paid out dividend in cash. So cash decreased by 1,300. And cash is an asset, so asset decreased by 1,300. And at the same time, it is the firm pay out dividend. So, and because dividend decreased the firm's retained earning account, so retained earning decrease. And retained earning is part of stockholders' equity. So stockholders' equity also decrease. And as you can see here that just to summarize, that each transaction must be analyzed in terms of its effect on the 3 components of the basic accounting equation, which is asset, liability, and stockholders' equity. And we also need to analyze its effect on specific type of item within each component. So does the transaction affect cash? Does the transaction affect account receivable? So those are different items within each component. And every transaction has a dual effect on the accounting equation, or in other words, that the two sides of the equation must always be equal. The accounting equation must always hold. That equal sign must always hold. Common stock and retained earning column indicate the cost of each change in the stockholder's claim on asset. Those just a summarize of the transactions, and this is the first step. So what we just talked about, this is the first step in the 9-step accounting cycle to analyze the business transaction. And we just talked about the first step in the accounting cycle. And now let's look at the products this accounting cycle produce, which is financial statements. So the 9-step accounting cycle basically produce 5 financial statements. Those statements are called the balance sheet, income statement, statement of stockholders' equity, statement of comprehensive income, and statement of cash flows. And the balance sheet is we call it a point statement, or it is a stock statement. For example, in December 31st, 2020, the firm may have a balance sheet. On December 31st, 2021, the firm has another balance sheet. It is a statement that captures the firm's financial position at a point in time. So those balance sheets are at a point in time. And all of the other statements, income statements, others, income statement, statement of stockholders' equity, it is also called statement of shareholders' equity. Those are the same thing. Statement of comprehensive income, statement of cash flow, all of those are flow statements. So they represent the change. For example, income statement disclose the financial performance during a period of time within this 1 year between December 31st, 2020 and December 31st, 2021. Within this 1 year, what is the flow? What is the financial performance of the firm during this 1 year? Similarly, the statement of stockholders' equity, statement of comprehensive income, statement of cash flow, those reports, those are all flow statements. They represent the, for example, statement of cash flow. It reports the change in cash balance during this 1 year. So now let's talk more about those 5 statements. First of all, the balance sheet, it reports the cash, the asset, liability, and stockholders' equity of a company at a specific date. So this is an example of Starbucks balance sheet. And as you can see here that this balance sheet, it contains different asset accounts. For example, cash, short-term investment, those are different asset accounts, and liabilities and stockholders' equity. And specifically, it discloses the balances for those accounts at specific points in time. For example, October 3rd, 2021, and September 27th, 2020. So those are on specific point in time. What are the balances for those assets, liability, and stockholders' equity accounts? This is a balance sheet and how it looks like. Income statement. Income statement reports the revenue, expense, and the resulting net income or net loss for a specific period of time. This is an example of Starbucks statement of earnings. So statement of earnings is another way to call income statement. Some firms call it statement of earnings. statement of operation. Some firms call it income statement, but those are the same thing. And for the income statement, as you can see here, that so it is the fiscal year ended in October 3rd. So in other words, it represents the firm's performance. All of the, for example, all of the revenues the firm generated during the year which ended in October 3rd. So it represents the firm's financial performance during this whole 1 year. It doesn't report the balances. For example, what is the firm's cash value at a point in time, which is reported on the firm's balance sheet. Instead, the revenue that is reported on the income statement that represent the revenue during the whole year. So, and then as you can see here on the firm's income statement, the firm's reports the firm's net revenue and different kinds of expense, different kinds of cost and expense. And at the end, the firm calculates the net income attribute to Starbucks. So this is called, net income is called the bottom line earnings, and revenue, because it is at the top of the income statement. So it's usually called the firm's top line. Statement of stockholders' equity. And this statement basically reports the source of change in stockholders' equity account. So, for example, on the firm's income statement, on the firm's balance sheet, you may see that the firm's total stockholders' equity is 5314.5, and then 5314.5, you can see it from the statement of shareholders' equity as well. And the last period balance is 7799.4. You can find it here. And the statement of stockholders' equity basically explains to you how the firm's stockholders' equity changed from 7799.4 to 5314.5. By the way, all of those are negative amounts. So this is basically an explanation to you why it happens. And as you can see here, that net income actually contributed 4,200.4 million to the change in those balance. Statement of comprehensive income. So statement of comprehensive income, it begins with the firm's net income, and then it is going to add, those accounts are called OCI, other comprehensive income. And other comprehensive income, these are basically unrealized gains and loss, which are not included in the firm's income statement. And we call it other comprehensive income. And net income plus other comprehensive income is called the comprehensive income. And the statement of comprehensive income basically reports the net income plus other comprehensive income of the firm. Statement of cash flow. Statement of cash flow reports information about cash flow, cash inflow and outflow for a specific period of time. So for example, you can see here on firm's balance sheet, Starbucks cash flow at the beginning of the year is 6455.7. And we can see here on the firm's cash flow statement that the cash balance is also 6455.7. And at the beginning of the year, it is 4350.9. And we can find it here. So, and we can also find it here. So the firm's statement of cash flow basically explains to you why cash balance changed from its beginning of the year balance to its end of the year balance. Those are just detailed items that are causing the firm's change in cash. So to summarize, we talked about the 5 financial statements that every publicly listed firm needs to report. And so what are the relationship among those major financial statements? We start from a snapshot of the firm, and we ask the question, what resources does the firm has? In order to find out what resource the firm has, you need to look at the firm's balance sheet. The firm may have cash, may have equipment, may have some inventory. All of those are resources the firm has. And then you may ask, how do those resources change during the year? So if you want to know the change, how does retained earnings change during the year? You look at the firm's income statement, because retained earning is the firm's revenues minus expense. And revenue minus expense, that's the firm's net income. And then we minus dividend. So dividend is not reported on the firm's income statement. However, you are going to see the firm's revenue and expense on the firm's income statement. And net income plus other comprehensive income, that is the statement of comprehensive income. And if you want to know how cash changed during the year, you look at statement of cash flow. If you want to know how stockholders' equity changed during the year, including how much dividend the firm pay out, you need to look at the statement of stockholders' equity. So those are the basic relationship among those financial statements. And that's all I want to cover in today's class.